Hey, what is up everyone? It's David here. In this video, I'm going to talk about how I minimize my tax bill as a retail investor. And it's one of those things that we don't want to talk about, but it's that time of the year. So let's get that out of the way. And then I will do a portfolio update because I did make quite a few changes to my portfolio. US inflation numbers came out, and also there's a new proposal for a higher global corporate tax rate. So I want to share my thoughts around that towards the end of this video. As usual, if you did learn something new, consider gently smacking that like button right there. And if you really like what I'm doing, consider supporting the channel via Patreon, try out my Discord server and see how you like it. Of course, this video is not financial or taxation advice. So if you do need help with investing or taxes, make sure you go see a proper professional. So without further ado, let's So I just want to point out that my situation have changed and I do have an accountant helping me out, making my life a little bit easier now. But for the first 5 to 6 years of my professional career, I've done all of the returns myself. I've done all of the calculations myself. So I want to come from that perspective. At the same time, I'm not going to cover too much about capital gains tax because it's something that I've already talked about in a previous video, which is on the screen somewhere or in the description box below. The tax rates might be a little bit outdated, but the principle and also the concept is still largely the same. So that would be a great video to watch after this one. So as a retail investor, especially during this time of the year, a lot of people bring up the idea of tax loss harvesting. So a simple way to understand tax loss harvesting is that, let's say, Otto had a great year investing in stocks and his CGT bill is massive. So in order to reduce some of his CGT bill so that he can buy more scallops, he might want to think about closing some of his positions at a loss to offset against his capital gains. Now, if that's what you're thinking about, please be careful with the concept of a wash sale, where the ATO prevents investors to sell their positions at a loss in one financial year before buying that same company back in the next financial year. ShareSite actually wrote a full article on tax loss selling, so it's in the description box below. Feel free to help yourself. I think it's an incredible resource if that's something that you're thinking of. Now, beyond that, minimizing my tax bill as a retail investor is actually super simple. There are only 3 steps. The first step is to go through the income page on the ATO website and then the deductions page. And then we wrap up everything by exporting the capital gains report from ShareSite and also a crypto tax tool so that we have everything that we need. So instead of talking about it, I want to show it to you on my computer. First thing I like to do is come to this side of the ATO website and click on income you must declare. Now, I am a very structured person and I prefer to operate by checklist instead of trying to do things on top of my head. So this actually gives me a checklist in terms of the different types of income I need to declare. I'll put all of the links in the description box below so you can feel free to help yourself. There are a few things I want to point out here if you're up to the income section of your tax return. For employment income, ATO does a pretty good job in picking up most of it, but they don't do a good job if you have a side hustle, if you consult companies on e-commerce or whatever the case might be. That portion of your employment income, you probably should pay a little bit more attention to because ATO is more than likely going to miss some of those and you need to fill that in. And when it comes to investment income, ATO does a pretty good job in picking up most of these, but again, they don't do a comprehensive job, so you need to make sure that you got everything covered. And I found that in my own experience, more than likely, they're going to miss some of the dividends and definitely some of the CGT stuff as well. So we'll talk more about CGT in just a second. What I like to do after the income section is to go to the deductions section. And on this page, there are 2 main categories of deductions. You have work related and also everything outside of work. This is basically a comprehensive checklist from ATO on what you can include and what you can't include in your tax return. It's basically ATO's checklist for you to minimize your tax bill. And in each of the sections within, there are documentation on to what extent can you actually include those expenses in your tax return. It's super helpful. I go through everything to make sure I leave no stones unturned. And at the same time, you know your circumstances the best. Some of these will apply to you, some would not. There's one more thing I want to mention when it comes to deductions, and that's basically keeping a record of work-related deductions. And this is my own process. So what I like to do is that for every year, I actually create a Google Drive folder for all of my different expenses, income, etc. So whenever those receipts come in, I just basically pile into that particular year. so that when it comes time to actually start doing your tax return or share it with your accountant, everything is inside and you can just share the folder with that person that's helping you do your tax return. It honestly makes my life so much easier after I started doing that. So that's an inspiration, especially if you have work-related deductions. One more thing I want to mention before we leave the ATO website, and that's the offsets and rebates section. The majority of these are going to be automatically applied for your tax return, but sometimes it's not. So you'll want to go through most of these to see if it applies to you and make sure that you're getting the rebates or offset that you deserve for your tax return. The last thing I do to wrap up my entire tax return is capital gains tax. I used to crunch a crap ton of numbers on Google Sheets, but
ain't nobody got time for that.
So nowadays, ShareSite does majority of the heavy lifting for me. There is a tax income report as well, just in case you miss any dividends or interest. But for the purpose of this section, I use capital gains tax report. And it looks something like this. Obviously, this is not my portfolio. This is a made up portfolio of GameStop. But you can see that there is a summary, and these are generally the numbers I put inside my tax return. It makes my life that much easier. And no, I am not sponsored. I'm just incredibly lazy. So if you do want to try it out for yourself, I left a link in the description box below as well. We will do a portfolio update in just a second. And on top of stocks, as many of you know, I do have a Bitcoin position and more recently Ethereum as well. I use CoinSpot to do most of my crypto investing. I'll do a video on them in a future date, but for the purpose of this section, for a CGT report on crypto, I use Crypto Tax for that. This is an Australian company and it produces a capital gains tax report based on Australian law. So that's applicable to me. Again, I am not sponsored. I am just basically incredibly lazy, and this makes my life a little bit easier. So if you want to try for yourself, I also left a link in the description box below. So that's basically my process on how I minimize my tax bill as a retail investor. But before we wrap up the video, let's do a portfolio update. Before I talk about the changes I made in my portfolio, I want to quickly talk about the US inflation rate and also the global corporate tax rate at approximately 15% with the G7. Now, with the inflation rate for the month of May, it came out at approximately 5%. Now, this is way higher than the Fed target of approximately 2% on average. The reason why the Fed, which is the central bank of US, is allowing the economy to run at a 5% inflation rate is because the economy has experienced little to no inflation. So they're allowing the economy to overshoot when it comes to inflation just to bring the average inflation to around 2%. Now, the reason why you should care about inflation is that in a high inflation environment, value stocks tends to outperform growth stocks. That's because if inflation gets out of hand, the central banks will have to raise interest rates, and that would destroy growth stock valuations. So your favorite growth stocks with no cash flow, no earnings, they tend to get smashed when interest rates go up. If you want to learn more about inflation, I've documented all my learnings with inflation in this video right here and the relationship between inflation and stocks as well. So that could be a great video to watch next if you're interested in inflation. When it comes to the global corporate tax rate at around 15%, it's mostly targeting US tech companies because they like to move their revenue to another country with lower taxes so that they don't have to pay as much taxes. At the same time, when we look at this graph right here, this is the US proposal of global minimum tax rate of 15%, but most countries have a corporate tax rate above 15%, with the exception of Ireland, Hungary, and maybe a few others, right? I think the downside to this corporate tax rate seems a bit overblown. And at the same time, if we look at a tech giant like Amazon, you can see that the effective tax rate have declined substantially over the years to around that 10 to 15% mark. So even if the effective tax rate go back to around 15 to even 20%, I don't think the market is going to tank. I don't think the world's going to catch on fire, right? I just think that some of the news are a little bit over dramatic. So with a portfolio update, my CMC market is worth around 99,000 Australian dollars at the moment, almost at 100. And I've deployed a big portion of my cash into Micron Tech, and I've deposited another into my portfolio as well. I've talked about why I like Micron Tech in a previous video. I have also left a link in the description box below. It's a growth at a reasonable price play on the semiconductors industry. So I like the company. We'll see how things pan out. This is the only change I made to the portfolio. It's around 5% of my portfolio at the moment. So no changes on everything else on this side. With my stake portfolio, it's currently worth around 40 to 41,000 USD, which is approximately 50,000 Australian dollars, right? And over the week, I have made one change, and that's adding a little bit more into Amazon. And it was really interesting that as US inflation numbers came in, the bond yield started going down, and that really pushed stock prices up. So we ended the week on a pretty nice note. And beyond that, I'm very happy with my position in Bristol Myers and Regeneron, and also very happy with the rest as well. So overall, I can't complain. I think that I am positioned if we were to go through another drawdown again. And even if interest rates go up, I am not going to sell any of my growth stocks. Now, I'm not sponsored, but if you do want to try a stake for yourself and wouldn't mind a free stock, I left a link in the description box. So thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very, very soon.